But
Hi, Edward.
welcome.
Thank you, Steve,
Hi,
very
how are
much.
you?
Edward, thanks for being here in between Christmas and New Year's, and what a great time to have you. So I'm going to, show your letter, and you're the author of Credit Write-Downs and newsletter. And so I'd like to start here.
Okay, great.
Because I'd like to start here on the yields here, Edward. And, with risk off, we had a nice little bond rally and rates have been coming down for a while. So I'm interested if you could tie in a fundamental view with what I'm saying technically. So here's the 10-year yield, if you could see the chart here.
I can, yes.
Okay, so my view is, if I go to a little longer term chart, a 4-hour chart, is that yields are bottoming here, and that there's potential, since we had this move from 320 down to 275, that there's potential for yields to go back up towards between 290 and 3% again. What do you think would be behind it? And then I actually think that if we rally here and then fail, we might be targeting 240 to 220 in the 10-year. Does that line up with what you're thinking fundamentally with your background in credit and debt?
It definitely does. What I think is happening is that we're at a period of uncertainty as to where the economy is headed and how the Fed's going to react to that. And so as a result of that uncertainty, initially we had a sell-off, which was sort of a bearish signal suggesting that the Fed needed to halt its rate hike regime and listen to the markets because the economy was slowing down. And that's where we are now. The question is what happens next? Because the real economy, the numbers that we see for Q4 are actually fairly good. If you looked at the retail sales numbers for Q4 over the holiday season from November 1st to December 24th, they were actually up 5%, which is the best that we've had in 6 years.
Oh, yeah. All the lemmings were out shopping. I mean, they have jobs. Okay.
Right.
They don't care about a 20% decline. But, there's an old Wall Street saying, what happens on Wall Street affects Main Street 6 months later. I want to just talk about what you're saying. So you're basically saying the real economy is still okay. And
Exactly.
Recessions don't start with decent macro data. But isn't there cases where there are financial accidents, even though the economy could be good, that could start a recession, like stock bubbles?
No, well, I think that really what you see is a lot of it has to do with credit. Even if you look at the internet bubble, the tech bubble, a lot of that in the TMT sector was as a result of a credit slowdown. That is that people basically were not getting as much credit. Credit growth was turning over, and that infected the real economy. So the way I look at it is that what we really should be looking at is what's happening in terms of spreads between treasuries and more speculative asset classes in the bond world, like junk or convertibles, as an example.
Okay. And isn't there a little something different going on in the corporate debt market this cycle, Edward, where a lot of the corporate debt is basically being rated as junk?
That's right. Yeah. So I think that what you're seeing is one, an increase in overall leverage, and two, an increase in issuance of highly levered companies within the junk spectrum. So everything is moved towards a more speculative, a higher risk profile. So overall, we have higher amounts of debt within the corporate sphere, but also even within the high yield spectrum, you have a huge slug of single B rated paper that, when the credit cycle turns down, as I believe it is right now, bad things are going to happen to those names. And we really haven't gotten to that.
Is there a lag time between when the credit cycle just begins to tighten and it having real impact in financial markets and the real economy?
Yeah, I think, it all depends on, I mean, we're in a turbocharged era these days, so it could be that it happens much more quickly. But if you look at residential credit, that is, if
Real
you look at
estate
the
or
housing bubble back
okay,
in the last decade,
right.
you saw the residential property numbers, and that's where all the credit was coming from, peaking in 2005, 2006, and we didn't get an actual recession until December of 2007. So it took a good year and a half, 2 years before you got the infection from the credit markets into the actual the real economy that caused the recession. So I think that 2019 is going to be the year where we're going to start to see this infection. And then the question becomes, how quickly does it happen? I don't think it's going to happen in the first half of 2019 that we're going to have a recession, for example. We might have a recession towards the end of 2019, but the downtrend in credit is going to be a second half of the year phenomenon in my view.
Okay, and the candidate for transmission is not residential credit housing this time, it's corporate debt.
Exactly, exactly.
Okay, let me ask you this. It's it exacerbated by a decline in asset prices because it's my belief that the tax cut and also all the corporate debt that's been put out there, that a lot of these listed companies have used it for financial engineering. So basically, they've leveraged their own stock through borrowing. Is that something that you have noticed, or am I way off base here?
Well, definitely. I mean that companies basically have not been doing any capital investment. So you have record earnings and at the same time record debt. So what they've been doing, as you note, is financial engineering. They've been buying back their shares and then leveraging up at the same time. And so they're in a much more financially precarious position. That makes them levered. That means that when the economy turns down, it's going to be much more quickly that they're going to run into trouble.
Okay, so also, isn't it that they're what could also exacerbate it is they're leveraging, like what happened in the last month, depreciating asset, and then more difficult to roll the debt on a depreciating asset, that a lot of these companies are going to end up with margin calls. Do you think that the stock buybacks that they've done, I'm not, I don't understand all the intricacies, but could they put that stock back out on the market and dilute shares because they're having a harder time rolling debt that they use to finance shares?
Well, no, I think that basically what's going to happen is that when it becomes difficult to finance yourself, it becomes difficult overall. A perfect example of that would be Tesla. If Tesla hadn't have bounced, as an example,
Yeah.
and the whole thing kept on going down, it would have been just as difficult for them to raise equity as it would have been for them to raise debt. So you're in a bind, and because you're in a bind from a debt perspective, that makes the equity markets turned off to you. I think that the perfect example from an economy-wide perspective is to look at the microcosm that we saw in the 2014, 2015 era with regard to oil, with regard to shale, the
Oh,
shale patch.
okay.
Because
Right.
we're seeing a similar sort of dynamic in terms of the downdraft in oil prices. And so we already saw this in terms of the shale bust in 2014, 2015, and the impact that it had in terms of capital investment on the economy meant that 2016 was a very bad year, and it caused the Fed to pause when they said they were going to raise rates 4 times. They only raised rates once between December 2015 and 2016. And so I
Okay.
think that we're going to see that sort of phenomenon, but on a economy-wide basis, not just in the one sector.
Okay, so do you think that we saw the last interest rate increase out of the Fed this month? What's your forecast for Fed action, and does a lot of it have to do with whether or not the stock market is recovering, or are they stock market dependent? Obviously, Powell wasn't stock market dependent last week. Will they become at a certain level stock market dependent because it is a cash register for the Treasury as far as tax receipts and
Well,
wealth effect?
I'd go back to your chart from before where you were talking about downside risk at 240 and then upside at 293 on the 10-year.
Yeah.
Basically, those are two different scenarios based upon the data that we get out of Q4 and the new data in Q1. Because if the data in Q4 are good, then what's going to happen is people are going to say to themselves, wait a minute, actually we've overplayed this. The data are good. The economy is going to run. The Fed is actually going to follow through with their rate hikes, and that's when you're going to see the upside scenario to the bond yields. The downside scenario is when the data are actually bad, and therefore people say, yes, the Fed is on hold. They're not going to raise in March. They might not raise in June. They might not raise at all. And that's where you get the 240 scenario that you're talking about. So I
Okay.
think that's where we are between those two scenarios, and the data that come out in January are going to be very instructive as to which of those two are going to happen.
All right. It's always been my contention, and, I guess you could call me, I'm always looking under the surface of what's happening, that the major reason for Fed interest rate increases and the roll off of the balance sheet, that's a little different, was to give them some ammo and insurance in case the recession you're talking about that happens at the end of next year occurs, which they'd have very low firepower at negative interest rates, real rates, and now we're not even quite at neutral. Is that your belief too, that the Fed is tightening so they're prepared for a cyclical downturn, which is way overdue since we've been in an expansion mode for a decade?
Well, they definitely have put that into consideration. I mean, if you don't hike now, when would you hike? And if you look back at all of the
2 years
cycles,
ago, right, man? The
right,
rear
yeah.
view mirror is good, isn't it? Anyway, yeah.
So if you look back over the past 4 or 5 cycles back to the Volcker days, the average cut in interest rates going into a recession and through the recession is about 5%. So the Fed basically has less ammunition now than they do in all of the previous cycles. And so given the fact that Trump passed these tax cuts and is running trillion-dollar deficits, we know politically at a minimum that we're going to have less fiscal space, because when you have trillion-dollar deficits in good times, you're going to have much more than trillion-dollar deficits when the fiscal stabilizers come into effect during a recession. And so all of the heavy lifting will fall on the Fed, and they don't even have enough rate cuts compared to the average recession in the past 5 or 6 cycles since 1980. So that's a big problem.
we're in real big trouble then, as far as depending upon the central bank to bail us out of a financial problem, aren't we? Can you speak to the big debate about yield curve inverting, whether it means something? People are trying to poo-poo it and say, yeah, it's forecasted 6 of the last 2 recessions. Yield curve inversion was pretty important in 2007-8. What's your feeling on that? Is it important? Should we be paying attention to it?
Yeah, I think we definitely should be. It's a market signal that the Fed should not ignore, and I think implicitly they haven't ignored it by rolling back their forecast from 3 to 2 rate hikes in 2019. Because if you look at the middle of the curve, what was happening as stocks were breaking down in December is that the middle of the curve, that is between the 2 and the 5 year, that was inverted. And in fact, right before we got the rally yesterday, we saw a 1 to 5 year yield inversion. So the entire middle of the curve had inverted. We had the 2 to 10 year spread at only 10 basis points. We were this close basically to the signal, and that signal traditionally has meant 12 to 18 months before the recession hit. And during that time, that's when markets are breaking down, when companies are defaulting, et cetera, into the recession. And so, now would have been the time for the Fed to back away, and that's what they've done. So I think that it is a good signal to pay attention to, and I believe that they have paid attention to it.
Okay, do you think we're going to have a depression, Edward? A lot of people are worried about, this is, the third bubble, 2000, 2008, this bubble's even bigger, financed by debt. Do you think the deleveraging is going to really be even worse than the Great Recession of 2007 and 8?
Well, I would say rather than it's being worse, I would compare this period to the Great Depression in terms of 29 to 33 recovery, and then another recession
Okay.
in 37.
Yeah,
That
37, the
on.
Fed tightened when we were starting to come out of it and took us right back down into the soup, but it took World War II for us to come out of it, didn't it?
Exactly. So I think that the risk here definitely is that we think that the deleveraging has ended, that we're out of the soup, but in fact there's a lot of risk, and the Fed, in their desire to reload for the next recession, might actually over tighten. That's always been the risk ever since they started on the rate hike regime, and we saw from October to December that risk was increasing exponentially, and so they
Although,
pulled back from that slightly.
Go ahead.
Edward,
My associate Steve Olgi has a question for you.
no, it's not a question. Although what I wanted to say, Coach, is that I think that it's we tend to interpret monetary policy and its effects completely mistakenly often. A lot of people still blame the 37 crisis to early tightening on behalf of the Fed. As I'm sure that there will be a lot of people blaming, and Trump is already trying to make the Fed the scapegoat, the next recession to the Fed. But I think that it's completely looking things in reverse, because the Fed is to blame, but not for tightening too early in either of the two occasions, but in actually letting
being loose too long.
Letting the politicians make it out of a tough fiscal situation, putting all the tools of policy just on the monetary policy, being too loose for too long, and creating bubbles which afterwards they had no alternative, or they had only two alternatives: A, to reinflate them and just kick the can down the road, or B, to finally stop the monetary policy madness, because when you're trying to solve problems that are at the biggest part fiscal through monetary policy, this isn't going to work in the long run, right? So I think that in this case, once again, we have a situation that began as a fiscal situation, but if they don't want to solve it,
so you can't blame the Fed. It's been really the Congress.
Fed, but blame them for what they did in the past, not what they are doing now. You understand what I mean?
What do you think of that, Edward?
Well, I'm of two minds on that. One is that I think it's the beginning of the tightening cycle. Once you've gotten a lot of malinvestment, a lot of excess in the market, is actually not, when the Fed raises rates, they're not actually tightening, they're loosening monetary policy, because what happens is you are pulling forward demand for credit. That is, people are saying to themselves, we're debtors, we see the Fed's tightening, we need to actually increase our debt loads now
in the short term. Yeah, you're right.
Moreover,
you're very right.
You're actually adding to interest income, so it's putting more money in people's pockets. So the pulling forward of credit demand, the addition of interest income, means that in the initial stages of the tightening cycle, it's actually an accelerant. And the reason for that, obviously, is that the Fed has waited too long. They've allowed the animal spirits to take hold, and so therefore the whole thing is going to fall apart. But on the other side of that, with regard to the fiscal side, I think that the way I would describe the fiscal is that really we've allowed monetary policy to do the heavy lifting. Ultimately, really what we should be doing is allowing fiscal policy to fluctuate with the economy more greatly and rely less on monetary policy. So I would actually say that, when we had the great recession, we should have written down lots of more debt. Fiscal policy probably would have gone deeper into the hole. And as a result of that, monetary policy would have been more aggressively higher. That is that the Fed would have felt comfortable raising rates much more quickly because they knew that they needed to offset the fiscal side. And so, unfortunately, we've just relied completely on the Fed to do all of the heavy lifting, and that meant zero rates for 10 years.
Yeah. And I mean, you can tell the market's used to it if they, you have this type of panic with really a neutral, not even a neutral rate. Last time you were on and we were having some technical difficulties, and then you sent me out a tweet, Edward, about you actually have a view on the dollar. But before we get to that, for older people, retired people that are interested in interest income or safety, where are you telling them to go into the debt structure to generate some, some interest, dividend, or whatever income during what might be, a storm that's gathering over the next 12 months?
Yeah, well, definitely you have your bank CDs. I think a lot of people are concerned about equities. If you looked at the sell-off in terms of equities at its worst, even the Con Edisons, the Dominion Resources, the Verizons of the world, which you would consider to be fairly high dividend stocks, they were doing poorly. But I think that those, consumer staples, utilities, they will actually bounce back in their low beta. You can definitely hide in those spaces. They're not going to be cutting their dividends. So I think those are definitely two places to go. And actually, I would invest in treasuries towards the middle to the end of the curve, meaning that if you look back at the beginning of the year, you had people like Bill Gross, you had people like Jeremy Grantham, you had people like Jeff Gundlach, who were all saying that the bull market in
bonds were dead.
Was over.
That was unanimous. The one unanimous thing, and I tweeted about it, was that everyone agreed the bonds had entered a bear market. You're on the other side of that.
Definitely, because at the end of the day, it's not going to be an inflationary bust, especially if you're worried about deleveraging. It's going to be a deflationary bust, and that means that you're going to end up in a Japan-like situation. I mean, if you look at where Germany is with 25 basis points, or actually 23 basis points today on their 10-year bond, that's an indication that people are running into those safe assets, and there's deflationary concerns over the longer term. That means the central bank is going to be on hold for a decade, by and large. That's what's happening in the United States. That's what is the risk of happening in the United States.
Okay, so you have a view on the dollar, and I think you're thinking we're very close to a significant inflection point, a high in the dollar. We've basically been moving sideways. You think we're close to that happening?
Yeah, I think that basically, when we got to about 97 on the US dollar index, we're now at 96. We've been trading around 96, 95, and bumping around there. That was pretty much the high. I don't see the dollar outperforming relative to other central banks, and that's because we now have a situation where the Fed is, is relatively speaking, when you look at policy differentials, the monetary policy in the U.S. is slowing relative to the rest of the world. If you listen to the ECB, their last policy statement, Mario Draghi was saying, yes, we're getting rid of QE. If you look at a lot of other central banks, they are relatively speaking, in a tighter position to the U.S. So U.S. interest rates and U.S. monetary policy is, relatively speaking, less tight compared to the rest of the world, and that's not supportive of the dollar. That means the dollar should be weak relative to other major currencies.
Okay, so the argument that demand for dollars is a big natural thing, not only because it's a reserve currency, but because most debt is dollar denominated, which creates a natural demand and shortage for dollars. You don't buy into that.
No, I definitely buy into that. But, we're talking about where are we in the cycle? Because, for instance, if you look at China as an example, I think that the Chinese are leading the way. We were literally 5 or 6 months ago talking about 7-to-1 of the yuan to the U.S. dollar, but now it's more like 688. It's moving in the opposite direction. That they started that move, because that's where the downward impulse in the global economy started, and it's been metastasizing and moving out to other places. And so this is happening elsewhere. At some point, the credit cycle in the United States is going to be infected enough that the U.S. is going to go down as well, and then that's when the sort of the financial market impact in the credit markets will happen. That's when people will start to want dollars again. That when there's a crisis, people will flee to the dollar. But until that crisis happens, there won't be the flight. I think we saw the same thing in 2007, 2008, that the dollar was plummeting right before the crisis relative to the euro and other currencies. And then as soon as the crisis picked up, everyone started to rush to the safe havens. And, I think that's probably going to be true for the yen. It will be true for the Swiss franc as well.
What a great interview, Edward. Thank you so much for coming back. A lot of people taking the rest of the year off, and, your views on the credit markets and rates and the dollar. I really appreciate you edifying our community today, and I encourage people to go to Edward's newsletter to stay informed. And here it is. What's a website for people to get there, Edward?
You can type in credit write-downs or www.creditwritedowns.com, and that'll take you right to the newsletter.
And your Twitter handle once more for our audience and people to watch the video.
That's Edward NH. So Edward and then N and H.
Okay. Well, Happy New Year, my trading warrior brother, and let's keep in touch and do this again, especially as we move towards your window. We'll get together at least another time or two before we get to the end of next year, and appreciate you being with us. And I learned from you today, Edward. Thank you so much. Thank you, Dale. It was good talking to you, and Happy New Year to you as well. Okay, guys, so that's a wrap for us on Thursday. Thank you, investing.com, for tuning in. And we'll see everyone to wrap up the week tomorrow. Remember, don't just count your pips, count your blessings. I count being part of the ForexAnalytix team as a blessing in my life. And all you guys that come in here to listen to us, as someone said today, blah, blah, blah. So I'll see everyone. See everyone tomorrow. Adios. Good hunting the rest of the day. Edward, thanks once more for being here and sharing your insightful views. Adios. Take care.